Hi everyone, this is Dale Anderson, Managing Director at Fabrik Property Group. So in case you missed it, the Chancellor Jeremy Hunt held the 2023 budget on the 16th of March. New measures were announced, but did they go far enough to support the property market is the question. Well, not really. What changes were announced for the property sector in particular? Only one small update was set out during the Chancellor's speech concerning the property market and updates to the VAT. DIY House Builder Scheme Digitization Project. The scheme is designed to enable people building their own homes or converting a non-residential property to be comparable to if they had bought from a developer, allowing them to reclaim VAT on some goods and services. The government has said it plans to digitalize the schemes plus extend the time frame for claims from 3 to 6 months in a bid to should improve the overall customer experience. With regards to the property market, there were a few direct announcements, but we can look at the economic news and forecasts to draw some conclusions for the future. The first point of note is that Hunt has declared the budget as one designed to ensure long-term sustainable, healthy growth. Whether this means anything concrete is open to interpretation, but the major target is to get inflation back in line as a means of increasing prosperity. So the Office for Budget Responsibility has declared it expects inflation to fall from its level of 10.7% at the end of 2022 to a much lower 2.9% by the end of this year based on the budget. So fairly good news for the economy overall, keeping inflation lower. If this is achieved, the OBR believes that Hunt's budget will lead to the economy contracting by 0.2% over the year as opposed to the 1.4% that was predicted back in November. So Hunt believes that the 2024 will see the economy growth of 1.8%, followed by 2.5% in 2025 and 2.1% in 2026, respectively. So what does this mean for the property market? The main thing to note is that by reducing inflation and slowing the contraction of the economy, Hunt aims to put the disastrous mini-budget delivered by last August by Liz Truss and Kwasi Kwarteng firmly in the past. Homeowners and investors will no doubt remember how the budget immediately sent house prices tumbling as markets fell, and everyone from all sides noted how extreme and unworkable it was. Inflation rose and house prices began to fall as confidence in the market fell. So if Hunt's budget makes a positive contribution to stabilizing the economy and returning confidence, then it's likely to have positive outcomes in the long term for anyone who owns a property. However, it should be noticed at this stage that inflation may begin falling anyway thanks to global conditions. So it is up for debate to what degree Hunt's spring budget will be able to take credit. In the short term, though, it seems likely house prices will continue to fall this year. Indeed, the OBR has revised its previous forecast of a 9% fall downwards and is now predicting a 10% fall this year. The OBR said leading indicators from Halifax and nationwide suggest that house prices have already fallen by 3 to 6% between their peak in the middle of 2022 and February 2023. So low consumer confidence, the squeeze on real incomes, and expectations of mortgage rate rises to come are expected to contribute to continued falls in house prices and a reduction in housing market activity. Those nationwide reports from February confirm the first annual decline in the cost of a home since June 2020. The annual drop overall was 1.1%. So while financial market conditions normalized some time ago, housing market activity has remained subdued, said Robert Gardner, Nationwide's chief economist. This likely reflects the lingering impact on confidence as well as the cumulative impact of the financial pressures that have been weighing on households for some time now. The lingering impact on confidence is one explanation for the fall. The other is mortgages, which became unaffordable for many with the 10th consecutive interest rate rise, removing thousands of potential buyers from the market at the same time. If inflation comes back under control in the time frame set out above, then it's likely that transactions will start to rise again due to the simple fact that interest rates will also be able to start falling again, reducing the cost of mortgage products. So what does this mean for home buyers and investors? Overall, there is a few outcomes here. You may want to look at buying different types of investments. If you do buy off plan, you don't have to worry about current high mortgage rates. If it's going to complete in the next 2 years, interest rates may have come down again. So, you need to think, will your property rise in value over the construction period as stability returns and the economy improves in the coming years? Likewise, you can stay out of the mortgage market until inflation and interest rates have fallen, then finalize on completion of the property in the future. People are also now looking for below market value deals. So we are getting some HMOs and houses and different types of investment strategies to weather the current market conditions. So my thoughts, the announcement to support the housing market were notably absent from the spring budget, leaving the country's housing crisis overlooked. We recently saw the government's commitment to its house building targets of 250,000 new homes per year watered down, which means the government is not keeping up with its own goal to ease pressure across all aspects of the housing market, in my opinion. It would have been great to see more support for home buyers, renters, and private landlords and investors actually ultimately stepping up to fill the gap in the supply chain. As industry leaders, we encourage the government to work closely with developers and investors seeking positive and sustainable change within the housing industry, particularly those working in the build-to-rent sector, working harder to deliver energy-efficient, sustainable properties to improve the living standards of renters. We also hope the government would reassess the impact of its tax burdens introduced landlords back in 2016 and the effect they've had on the market. According to UHY Hacker Young, 70,000 buy-to-let landlords have left the UK's rental market over the last 12 months, pushing the cost of renting up through a lack of supply of rental properties. So whilst property prices are coming down, we are seeing rental inflation in the market and things are becoming less affordable. Overall, the UK fundamentals are still there. There's a shortage of property. There's not enough new houses being built. If you want to book in a consultation or contact us today to find out what different strategies we can recommend for current market conditions, please click subscribe. There's a link below where you can book in a meeting if you want, and we can discuss the best investment strategy that works for you. I hope you found this useful. All the best and take care.